The Spinoff Podcast Network. AI wouldn't be possible without the internet, nor the internet without computers. Computers came from brilliant brains, and even they had to learn that fire was hot and water was wet. The world is constantly shifting, changing, evolving, and Daylight is an award-winning creative and technology studio that helps ambitious clients shift with it. Search daylight.nz to get in touch.
This episode is brought to you by Global X. Since 2008, Global X ETFs has been committed to empowering investors with unexplored, intelligent solutions. Global X specializes in exchange-traded funds that offer exposure to the artificial intelligence ecosystem, including themes like data centers, robotics, semiconductors, and cloud computing. To learn more about Global X's entire suite of ETFs, from covered calls, fixed income, emerging markets, and more, visit globalxetfs.com.
When the Facts Change is brought to you by the Spinoff Podcast Network, in partnership with KiwiBank, the bank for Kiwi looking to get ahead in business and in life. A bank that delivers expertise and banking know-how, smart advice for business owners wanting to invest, grow their business or diversify. A bank that adapts with technology through the lens of its people and customers. It is a bank with heart that is driven by its purpose. Kiwi making Kiwi better off. There are moments in your working life when you realise you're about to sit in the box seat on history, a moment in history. And way back in 2006, I found myself in that place. I was working as the business editor for the Dominion Post and about to become the head of digital at Fairfax, which is now Stuff. And I went to a press conference about Fairfax buying a website that I didn't know much about at the time because I'd only just arrived back from overseas, called Trade Me. And I'd heard it had been quite successful and that maybe it was worth tens of millions of dollars. But when I walked into the room that day and picked up the bit of paper, it said that Trade Me was being sold to Fairfax, now Stuff, for $750 million. That was an event. It was a big event in New Zealand's economic and commercial life. It was a milestone deal. It extended the life of Fairfax and those newspapers in New Zealand for some time. And it turned out to be quite a successful partnership while it was going between Sam Morgan and David Kirk, the chair of Fairfax at the time. But one of the key people behind the scenes at Trade Me was Rowan Simpson. He's described in the preface to his book, How to Be Wrong, A Crash Course in Startup Success, he's described by Duncan Greive from Spinoff as the most important figure in NZ tech that you've never heard of. And I agree with that. Rowan Simpson has been at the scene of some of New Zealand's most successful startups in the tech world. And he's quite a deep thinker. He's a great writer. And this week on When the Facts Changed, I sat down with Rowan Simpson to talk about the learnings of his times with various tech success stories. And we actually got to the point of talking about that moment in 2006, when I looked at a bit of paper and asked him a question this week on When the Facts Change. Well, kia ora, and welcome to Rowan Simpson to the Spinoff Studios for When the Facts Change. Rowan, it's great to see you again.
It's great to be here. Thanks for having me, Bernard.
So you're not a newbie here. We've had you on the show before during...
Not in the studio, but yeah, I have been on this once.
And we have known each other before as well, to just get some declarations of interest out of the way. We not quite worked together at Trade Me, but I was on the advisory board when you were heavily involved in that point just after it had been sold to Fairfax. Yeah. And this is something most people don't know, but about just over 10 years ago, you actually built a little website for me, which in retrospect should have been Substack.
I was going to say, yeah, we sort of missed a beat there, didn't we? But.
So we've known each other for a while, and I've been a huge admirer from a distance and up close. Ron, you've just built a book. You've just written a book called How to Be Wrong, a crash course in startup success, which isn't really the sort of Google question or string you'd expect someone to type in, I want to know how to be wrong. I want a crash course in startup success. Firstly, could you tell us why you've written this book?
Yeah, sure. I mean, I've been writing about these companies that I've been working on now for more than 10 years, Bernard, for many, many more than 10 years, for that whole time. So it's great to kind of pull all of that together and try and, I guess, take the aggregate lessons from that. There's a lot of patterns when you've, like I have, had the opportunity to work on the ground with 4 great companies and many others as well. On top of that, you start to see some recurring themes. And so, yeah, this is my attempt to kind of try and summarize that up in a way that hopefully other people can apply to the things that they're working on.
Yeah, let's start off at the beginning, which is Trade Me for most people. The first time I met you or saw you, I think, was actually on that day in 2006 when Trade Me was sold to Fairfax for $750 million. And we were all blown away by the price and looking at the press release, shaking our heads, going, this is crazy. This will never happen again. Or how on earth did this happen? What crazy thing went on?
I actually remember the exact thing you said because I was standing at the back of that room during the press conference and I was standing next to Mike O'Donnell, Mod, who is head of communications amongst other roles for Trade Me in those days. And you turned around and said to him, is the decimal point in the wrong place? So that gives you a sense of how the business journalists in the room kind of responded to that announcement.
And it was a big moment. It was the hero moment, the victory moment. But what I like about your book is that you've gone through not really the victory moments, but the moments when things almost went pear-shaped. Yeah. And let's start off with Trade Me. You've picked out a time in 2001. So that's 5 years before the sale and a couple of years after it started. How close was Trade Me to not being a thing?
I mean, it was basically dead. We had run out of money. Sam had raised a small amount of capital a couple of years prior to that, which had all been spent. From my perspective, I'd spent a couple of months at that point working for more or less nothing on the business. It was being propped up by shareholder loans. I was a shareholder. I had no money to lend, so my contribution was time. But that became untenable for me, and it was time to do my OE and head off to London, like lots of Kiwis do. But actually, that was true for Sam and Jesse, the founder and his sister, who was the first employee before me. We were all in London at that point, and the site was being held together by String and Blue Tack back in New Zealand by Nigel Stanford. And it's fascinating. I was really determined to start this book with these near-death moments because, like that story you tell of the glorious exit to Fairfax, that's a well-worn story. People have heard that and they're familiar with it. But these moments where, the company's in deep trouble and things are struggling, those moments get airbrushed out of the stories or the narratives of startups. And so from my perspective, that's the most interesting bit of all of these stories is not the wonderful moments in the spotlight, but the hard grind well away from an audience. And yeah, it's a great example of that. Like very few people, I think, would even know that part of the Trade Me history.
Because Trade Me initially started as an advertising-funded classified site. And it was only just before you left for the OE, you thought, let's put in a success fee system. And that was the turning point.
It was one of the changes we made at that point. And I mean, let's not pretend retrospectively that was a strategic insight. We were seeing what sites like eBay and others were doing overseas, so we had some precedent. But we also were more or less, it didn't hurt to try other things because what we were doing wasn't really working. So it was a bit of a last roll of the dice, and little did we know that it was going to turn into, such a lucrative business model that only a few years later, as you say, would underpin that exit. So,
and you came into Trade Me with Flat Hunt, a very, very small classified site for flat hunters.
Yep.
You were doing programming. You were actually on the ground in with the kit and coming up with the ideas and creating this thing. What did you learn as a creator, a business builder through that process?
Yeah, I mean, my background's software engineering. I did a computer science degree, so my bias was very much that the hard thing about a startup is building the software. So that's what I did. And of course, very quickly got slapped in the face with the reality that, first of all, no one even heard of the business that I was trying to promote to them. So, overcoming obscurity, as I describe it in the book, is a much greater challenge than building great software. But secondly, kind of, back to that business model, maybe in larger countries, a site like Flat Hunt is viable, standalone. But in a small country like New Zealand, I think one of the real insights from Trade Me was we aggregated what would be separate businesses in large parts of the world under one umbrella. And really we're just able to pick off the classified categories from traditional media.
So scale, and also having a business model that pays the bills sounds like
and also, like, one of the delightful things about when I started to work with Sam and Jess at Trade Me was having a team. Like, I was a one-man band working on Flat Hunt, and there are things that I'm good at, there's other things that I'm really not good at and still aren't that great at. But having that team of people who were a little bit broader to work in was really delightful. Those were the good old days, Bernard.
Yes, 2006-07, and then you went on to Xero. Now we all know about Xero now. I bet
you all know about some parts of the Xero story.
Yeah. Many of us will be customers, just as we were customers of Trade Me. They're both sort of iconic, successful brands and stories in our collective business psyche for the last 20 years or so. But it was never plain sailing for Xero, and right from the start, it was precarious. I hadn't realised until reading your book that Xero actually listed with just 100 customers, and even after a couple of years, it was really a tiny business. There would have been dairies that turned over more than Xero.
Yeah, I mean, as I say in the book, I think in the first year of operation, we earned more from interest on the unspent cash in the bank than we earned from customer subscriptions. So it was very small and precarious, and massively out of sync with its public profile because it was publicly listed and getting a lot of coverage. So those were hard days in terms of filling that gap between perception and reality.
And what was the turning point there? Because it was supposed to be profitable within 3 years, turned out to be 13 years.
Yeah.
And at some point, when you're burning cash, there's nothing left. So what was the moment when you actually could feel the hockey stick going up rather than down?
Yeah, and I mean, the specific thing that I pin it to in the book is when Craig Winkler, who was the founder of MYOB, which is Xero's biggest competitor in Australia, chose to invest. Again, a lot of the details of that are forgotten to the passage of time. So he invested at 90 cents per share, I think more than a year or more than a couple of years after the IPO at $1. So the shares had been, effectively underwater that whole time. It wasn't a glorious stock market success story at that point, but certainly from a capitalization of the business perspective, that was true. And then around the same time, the sales team also pivoted to much more focusing on selling through accountants rather than selling over the top of accountants. And little did anybody know at the time that was a river of gold that Xero would ride for many years to come.
So this was slightly different to Trade Me in that it was a bit more of a corporate thing. People started off being well paid. It was well funded. It had already had a big success story running it, Rod Drury, who'd come from Aftermail and had done very well. What did you learn through Xero, where you were getting close to the sort of executive level? You were in the leadership team, but you were still in the business. You weren't on top of the business or investing in it directly.
Yeah.
What did you learn there?
I mean, they're very different businesses. I mean, even on the surface, Trade Me was a massive domestic success, whereas Xero's ambitions were always bigger than that, to be a global success. Sam and Rod are very different characters themselves. Sam's very analytical. Rod is much more sort of belief-driven. And so, to be part of the Xero team in those days was invigorating because we were dreaming big. But at the same time, there was a lot of work to do to bridge that gap I talked about between perception and reality. It was a difficult team to be part of for that reason, for many reasons. not only because of the approach, but also because of the size. Like, one of the details of the Trade Me exit that, again, is lost to the passage of time is there were only 53 of us at Trade Me when we sold it for $750 million. So do the maths on a per employee basis there. The team at Xero by the time of the IPO was already about that size. So, we were burning a lot of money. And the results, took some years to catch up with that.
Yeah, in a way, that was a company that probably now wouldn't have got onto the stock exchange in that state. And being allowed to burn cash for 13 years, companies in New Zealand, at least the ones that are listed, they're not allowed to do that. They have to come up with dividends real fast, or in fact, start with dividends.
Yeah, there was a famous question in one of the early AGMs, actually, where an old guy stood up at the back and said, how soon can we expect this to start paying dividends? And I remember it very clearly because Rod just dismissed the question. He was like, we're dreaming big. We're not going to swim to the side of the pool. And that expression just sort of perfectly captured, the Xero ambition for me. It was a big bet, and if it came off, it was going to be huge.
Yeah. So you'd done the building from within, and then you moved on into what you could call being a director, governance, and more pure investing.
Yeah.
And in particular, Vend, a company that many people will have known of, another company with a quite high-profile founder, CEO, Vaughan Rousell. And Vend didn't have a simple time of it either. Could you tell us about that moment in 2015 when it all went pear-shaped fast and you had to do some heavy director load?
Yeah, I mean, it's interesting you describe my role as director. I mean, in the very beginning, I was their first investor into Vend with Sam and a couple of others. And in those early days, describing my role as director is sort of massively overcooking it, really. It was much more of a sort of trusted friend, advisor, therapist, shoulder to cry on, all those sorts of roles for Vaughan when he was, a solo founder and starting to build out the team. So that moment in 2015 came, a few years after that, 3 or 4 years into the story, and we basically nearly killed the company. We were growing fast, same story as Xero. Growing at that sort of rapid global pace requires a lot of capital. So we would have to go back cap in hand to investors every 18, 24 months in that process. And a story which has been repeated in New Zealand a couple of times. We had an international investor lined up who pulled the pin and we were left hanging. And that was a dark day. I was actually randomly in Berlin. We'd just recently hired a team in Europe. So we had some colleagues in Berlin who I'd never met. And so I was there with one of our Australian investors. And rather than meeting the team, we effectively had to tell them that we were pulling the pin and that team would be disestablished. So those were awful conversations. And then, very quickly having to scramble to shore it up from a funding perspective. Our payroll each month was, even after the cuts, significant. And it wasn't obvious that the company would survive for quite a long time after that.
And how did it?
Well, eventually, with some hard work and some support from our existing investors, thankfully, we were able to refinance it effectively. We made some deep cuts to the team, which, as I've described, was hard for everybody. A lot of those folks were the people who had actually helped the company get to where it was, and that was the end of the line for them, sadly. But yeah, we managed to put it onto a sure footing and do enough to keep it alive. It was shortly after that it was made clear to me by the shareholders that I no longer had their support. So that was also the end of the line for me in terms of day-to-day involvement in Vend. But thankfully the company continued and eventually flourished again.
And was sold for $485 million in the end. And the scale of the value creation in a short period of time is quite foreign to a lot of New Zealand investors. They like a good 5-10% per year on year.
Yeah.
They don't like prices to go down.
Yeah.
We all feel it when the value of something goes down. We feel it a lot more actually than when the value goes up.
Yeah.
But that explosive value growth.
Yeah, the decimal point is in a different place, to borrow an expression.
Right.
Yeah, that's true. And I mean, that comes with, it comes attached to that massive uncertainty, right? And so, the outcomes when they go well are much, much greater, and amazing. But the variability is also much, much greater. And I guess the bit that I've written about and really tried to describe from my own experiences of it in the book are the variability through that process, even as you go. And so like all of these examples are remembered as successful companies, but they very rarely felt like successes en route.
So what did you learn through that period of then where, as you said, you were asked to step down? It was a success in the end, but an awful lot of pain through it. Is there anything you'd think, okay, that's something, I'm not going to do that again? Or actually that worked, that thing we did worked?
I think like at a really surface level, being very clear about that choice that you're making when you're growing a company as fast as that to require investor support on a frequent basis like that is a great lesson. And I mean, we'll talk maybe next about Timely, but by comparison to then, the folks who were running Timely were a little bit more conservative, a little bit more managed growth. Like we still grew very quickly and it still achieved a great outcome, but without that kind of VC mania kind of fueled approach to it. And people can argue or decide for themselves which is the better path. I don't know that there is a better path. They're just different. But that was one of the things I took away is there's actually, as long as you're explicit about it and really understanding the risks you're taking, then that's important.
When the Facts Change is brought to you in partnership with KiwiBank to help you understand the issues affecting the economy. And that's what their team of experts is here to do too. Here's KiwiBank's Chief Economist Jared Kerr with his prediction on what we can expect from the housing market and interest rates for 2024.
We've seen quite a correction in housing across the country. So house prices fell from the lofty levels that we saw in 2021. The Reserve Bank has pushed house prices down by design and by lifting interest rates to very eye-watering levels. I think the housing market has found a bottom, and I think we'll see house prices rising over 2024 and into 25, 26. The housing market will be better balanced. We have seen a surge in migrants, which is adding demand to the housing market, and I think we'll see house prices naturally lift on the back of that surge in migration and hopefully an easing in interest rates later on.
Visit kiwibank.co.nz to stay up to date with detailed economic analysis and forecasts from Jared and other KiwiBank experts. They take big issues from both here and overseas and make them relevant to Kiwi businesses.
This episode is brought to you by Audi. The road is calling. Embrace the thrill of the drive with the all-new, fully electric Audi Q6 e-tron. Featuring effortless power, serious acceleration, and advanced Audi tech. It's not just a new EV. It's a new way to experience driving. The all-new, fully electric Audi Q6 e-tron is here. The next chapter of Audi starts now.
You know what's smart? Enjoying a fresh gourmet meal at home that you didn't have to cook. Meet Factor, your loophole in the laws of mealtime. Chef-crafted meals delivered with a tap, ready in just 2 minutes. You know what's even smarter? Treating yourself without cheating your goals. Factor is dietitian approved, chef prepared, and you plated. Pretty smart, huh? Refresh your routine and eat smart with Factor. Learn more at factormeals.com.
Well, let's talk then about Timely, the fourth in the story, which maybe not as well known as Vend or Xero or Trade Me, but again, one of these impressive software as a service companies, one of the next generation of Kiwi companies that worked out that if you could provide a service to a small business through the cloud with a monthly return, you could make a solid business with an annual run rate, which was going to be attractive to investors. Tell us about the Timely story, and in particular, the moment in 2020 during COVID when things were ugly.
Yeah, I mean, of the four, ironically, even though it's the smallest, headline number. It's probably the one that I'm most proud of because of the way we approached the business and the people involved and how that was executed. So there were 3 founders at Timely. Their previous venture had been acquired by Trade Me, actually. So when I first met them, they were working through their, the earn-out period of their previous venture and had an unscratched itch. And so, I was able again to be their first investor and worked closely with them through those early stages, which was really delightful, and applying a lot of the lessons that I'd learned by then from these other businesses we've talked about, try to help them as much to avoid the mistakes that we'd made elsewhere and to make new and different mistakes instead. I think, the Timely story probably might have been the exception to this, near-death moment kind of narrative that we're talking about, except for COVID. And so obviously when your business is selling software to health and beauty businesses who all take bookings each week to sustain their business, and all of a sudden the world shuts down and you watch those forward bookings just disappear, evaporate, that's an existential moment for that kind of business. And so, it required some really remarkable leadership.
So what did Timely do to make sure that it still had some cash flow and it kept some customers at a time when those customers were on their backs themselves?
Yeah, I think it was a very different response to our competitors. So we didn't try to hide from that reality. We were upfront, even with the customers, to explain, the situation. They knew the situation, but we weren't trying to spin it or pretend otherwise. So we were pretty generous with giving extensions to subscriptions and things like that to retain a relationship with customers. We cut pretty deeply. Directors' fees got cut to zero. Executive fees, salaries got cut pretty heavily. And Ryan, who was the CEO and founder, his mentality was very much, we'll get through this together. So we'll all take a small hit rather than any one of us taking a massive hit. And if we're really clear about the decisions we need to make and how we need to manage this, then maybe we can get through it together. And that's ultimately what happened too.
So that's part of the invest part of the book. We've talked about build and invest. And the final part is around grow. So this is creating an ecosystem of companies, of people, of technologies, energy, which starts to build its own weather system. It starts to become like a flywheel. Not only do you get great big companies, but they create great big companies, and you start to get a bit like a street where there's 5 jewelers all together in the same place. You get a hub. The Singaporeans love the phrase hub, but New Zealand's wanted to build its own hubs and have its own ecosystems for a long time, and we have a view of ourselves that we're really good at business, that we're really good at, we're plucky little Kiwis at the bottom of the world and we punch above our weight and, look at the All Blacks and got all these things. Look how good we are. We're better than the rest of the world. We always win everything per capita.
On per capita basis.
Yeah.
No one cares about per capita more than New Zealanders.
No, that's right. So there's been a lot of talk about how we're going to ride this knowledge wave and we're going to have all these great businesses. And of course, we've had successes. And we think, wow, if Trade Me and Xero could do it, we could just times it by 50 and we'd all be rich. We've heard some really inspiring words from Sir Paul Callaghan, which eventually turned into Callaghan Innovation. And the big news in the last couple of weeks is that Callaghan Innovation has been shut down. And, it's a bit of a body blow to the idea we have that we're going to rebuild our economy around growing value and exports and being competitive and high tech and high wages. When, we just dismantled that. Fonterra, one of our great sort of global hopes, has actually just pulled back from the rest of the world. We've got a bunch of companies that have fallen over in the last 6 to 12 months. And the government is focused mostly on rewarding owners of residential property. If you look at the tax cuts produced, they've gone by volume largely to landlords. So it's a different time. Was Callaghan Innovation working? Was it a good idea? Did we need it? Or maybe it's not the solution?
I think the evidence would suggest, if we were brave enough to actually look at the evidence, which for a long time we haven't really, the evidence would suggest it hasn't really worked the way that we might have hoped. We talk a lot about an ecosystem, and it's great to pin it back to that famous Callaghan talk. I was actually lucky enough to be in the room when he gave that presentation, and it was very memorable. And we've continued to repeat a lot of the expressions that he used in that talk, be the place where talent wants to live, and the things that are successful are going to surprise us. They'll be obscure niches. These sorts of things have become sort of part of our folklore of how we're going to achieve these outcomes. And yet often what we did were the exact opposite of that. And so, it's sad for the people who are affected by the change, but I think it's a necessary reset in terms of Callaghan innovation. I think that one of the things I'd like to see maybe is a way of more directly connecting the dots between the things that we do to try and encourage and build and grow this ecosystem that everybody talks about and what actually works. Because despite all the noise in the ecosystem, there have been some amazing companies created, and there continues to be amazing companies created. So I much prefer to think of the ecosystem as the collective noun of startups. It really is just the umbrella of all the individual companies and all the individual founders and people working on these businesses, people investing on these businesses and trying to grow them. And if you have that mindset of an ecosystem, arguably the ecosystem's as strong today as it's ever been. There are some really great companies staffed by people in many cases who have spun out of Xero and Trade Me and Timely and Vend, funded in most cases by the outcome of those exits that we've just talked about. That is the fuel that funds the next round of companies. So with that lens, the ecosystem is in strong shape, and I predict will continue to build. And yet most of our focus, certainly at a government level, is on the top-down view of the ecosystem and what we can do to put in place hubs, as you say, or accelerator programs or grants or funding or venture funds that might encourage that to happen. And, that's a political question and a political judgment, but I think the bit that should be non-negotiable as we sort of go forward with that is really setting up clear and easy ways to assess the impact of those things that we're doing that we think are going to help, because historically they haven't really.
Yeah, because there is this idea from a big picture point of view, trying to pick winners, trying to identify the small companies that are going to be big.
Which, to be clear, is the exact opposite of what Callaghan proposed in that famous talk. Right? He literally predicted that the things that would be our successful companies would surprise us, which is, basically saying in as many words, you're not going to be able to pick them in advance. We should take more of those things on board when we design policy around that.
So one of the things I like to ask usually at the end of the podcast, a guest, is, I make you Prime Minister.
Make me Prime Minister?
That
would be a disaster, Bernard.
Well, let's say you're in there for long enough to do the things that are necessary to make this country, richer, better, happier. And, I know you think about these things a lot. What is it that could be done with, the billions of dollars that is spent by governments, be it Callaghan Innovation, R&D tax credits, NZTA, mentoring programs or whatever it is. What would you do to the settings or maybe just, clear everything out of the way and just not
scorched earth? I mean, if that's, that would be extreme. I guess the first thing I should say is I will never be Prime Minister. I find the whole tribal aspect of politics deeply demotivating. I'm much more interested in what works and much more interested in thinking about things from that perspective rather than which
so maybe not Prime Minister,
thinks, but
dictator instead.
Right. Well, maybe that would be even more scary to many people. But let me give you a kind of strategic thing that we could do, which is to articulate much more clearly what we actually want from these companies collectively, because I feel like we haven't even really done that in New Zealand very well. And you can sort of take that down from a very practical level, thinking about how these companies actually contribute to government. We don't tax capital gains, so there's large percentage gains that you've described as we've gone through these examples are not captured by government. But we do tax PAYE, we do tax GST. So both of those, all of the capital that's raised by these companies, to the extent that it's spent in New Zealand, that is a contribution to government. All of the high-paid jobs that these companies create, Vend, hundreds of jobs were created in Auckland around that company, and very well-paying jobs. jobs that are kind of, the salaries are kind of international salaries, which is a bit unusual for New Zealand. And so, that's a significant contribution to government. So, my advice to anybody thinking about that, whether they're the Prime Minister or whether they're just policy people thinking about what comes next from the ashes of Callaghan Innovation, would be to be very clear about what we think we want these companies to contribute, and then design our interventions around that, and design them in a way that's much more easily measured quickly. So, this whole fail fast mantra of the startup ecosystem, I'd love to see some of that thinking applied to the way we try and support the ecosystem from the top down too. And that's not to say, big scale failures. Like, the real gold in that idea of failing fast is lots of very small failures repeatedly, but with small feedback loops. So you learn quickly and you can iterate and build on those so that you're better in the future. And, even applying a little bit of thinking like that to some of these things that we spend, as you say, hundreds of millions of dollars on, would be much smarter.
Just finally, in New Zealand, we've got this idea of the batch, the boat, and the BMW. Once we get to the point where we're financially stable, we actually stop. We don't want to become the big swinging success in the world, and that's something in our national psyche we need to accept. And that the way for most people to get ahead is to own their own home, maybe own a couple of rentals in a batch, and the price of land will rise. The risk-adjusted, volatility-adjusted return after leverage is always going to be way higher than the risk-adjusted return of investing in your own business or investing in someone else's business. When you look back, that $10,000 or so you had invested in Flat Hunt, which turned into $30 million or so, you must think 2006, if I had invested $30 million geared up in just plain old land and then gone to the beach for 15 years, you maybe would have done better.
I don't think so.
Yeah.
I mean, that's kind of the bit that's missed in this story is, the reason I was able to invest in Xero is because of the Trade Me exit. The reason I was able to invest in Vend is because of the success of Trade Me and Xero combined, and so on and so forth. And that continues today. I'm an investor in a number of companies today that I'm actively working with, and hope to have in the future more stories like these to share of those successes. And on a percentage basis, the returns from all of those investments easily beats residential property. When I hear people talking about that as the way that we get ahead, I always like to ask, get ahead of who? Because another framing of that,
the tenant.
Well, exactly. I mean, another framing of that is that we have, through the process of that, made housing unaffordable for everybody, for all of us, including all of the people that we need to live here and work on these businesses. So, the biggest constraint for the ecosystem, the biggest constraint for any individual company in the ecosystem is people. Like getting the smart people we need to work on these companies, to live here and contribute to them, is our biggest constraint. And making housing unaffordable for all those people is very counterproductive. So, yeah.
Rowan Simpson, the author of How to Be Wrong, A Crash Course in Startup Success. Rowan, wonderful to have you in here.
Thanks for the opportunity.
Ngā mihi nui. Ka kite anō. When the Facts Change was brought to you by the Spinoff Podcast Network, together with KiwiBank. Visit kiwibank.co.nz to find out how KiwiBank are making Kiwi better off.
The Spinoff Podcast Network.